Welcome to TalkTickers, your deep dive into the most important earnings calls.
Glad to be here.
Today, we're unpacking the recent Q2 2025 earnings call from AppLovin's, that's ticker APP.
Right, and this one generated a lot of buzz, a really interesting report.
Absolutely. You had these incredibly strong financial results, but also this bold strategic pivot happening at the same time.
And the market's initial reaction was, well, a bit nuanced, wasn't it? A dip, despite great numbers.
Exactly. So we're here to help you understand the full picture, from the core numbers to, the game-changing opportunities potentially ahead, how this sort of gaming ad giant is trying to become something broader.
It's a fascinating transformation story unfolding.
Okay, so let's kick things off with a snapshot of those Q2 2025 results, the headline numbers.
Let's do it.
First up, GAAP diluted EPS, that's the bottom line profit per share. They reported $2.39.
Which absolutely smashed the consensus estimate of $1.96.
Yeah, a huge beat. And that's a stunning 169% increase year over year.
Almost 170% jump year over year. That kind of profit growth is, well, pretty remarkable for a company this size.
So what was driving that? Was it just cost cutting or something more fundamental?
Oh, it was definitely more fundamental. That EPS number reflects really strong underlying revenue growth combined with some exceptional operational efficiency.
Okay, let's talk revenue then.
They hit $1.259 billion. That beat the $1.22 billion consensus by about 3%.
Okay, so a solid beat there too.
And importantly, that represents robust 77% year-over-year growth, looking at their continuing operations.
77% growth, wow.
But maybe even more telling is the adjusted EBITDA. That came in at $1.018 billion.
Over $1 billion in adjusted EBITDA for the quarter.
Right, nearly doubling year over year. And check this out, an 81% adjusted EBITDA margin.
81%, that seems incredibly high. That speaks volumes about their efficiency, right?
Exactly. It shows they're not just growing the top line fast, they're doing it incredibly profitably.
And that profitability, does it flow through to cash?
It does. Free cash flow, FCF, was a healthy $768 million. That's up 72% year over year.
Strong cash generation and their cash position.
End of the quarter strong, $1.2 billion in cash on the balance sheet.
And it looks like they put some of that cash to work buying back shares.
They did. Repurchased 0.9 million shares for about $341 million. That helps reduce the diluted share count, boosting EPS over time.
So, okay, walk us through that again. Why is a company buying back its own stock generally seen as a positive sign?
Well, typically it signals that management believes their stock is undervalued. They think investing in their own company offers a better return than maybe other options. Plus, it directly benefits existing shareholders by increasing their ownership percentage.
Right, so you've got this picture, huge EPS beat, strong revenue growth, incredible margins, solid cash flow, share buybacks.
All the ingredients for a positive market reaction, you'd think.
Yet we saw that immediate after-hours dip of over 4% before it kind of stabilized.
Yeah, that was the intriguing part. It suggests that investors, while impressed by the numbers, we're also really digging into the strategic shifts and what they mean for the future.
Maybe digesting that big pivot we mentioned.
Exactly. It wasn't just about the quarterly beat. It was about the bigger story, the transformation, and maybe some people just taking profits after a good run.
Okay, let's peel back that layer then. Let's talk strategy, because this is where things get really interesting, especially for anyone watching AdTech.
Agreed.
A huge move was completing the sale of their legacy apps business. Sold it to Tripledot for $400 million.
Right. And crucially, AppLovin also got a 20% equity stake in Tripledot as part of that deal.
So it wasn't just about getting cash. There's an ongoing interest there. But this move, it's more than just cleaning up the books, isn't it?
Oh, absolutely. It's a major strategic statement. They basically shed a business that was actually diluting their overall earnings profile.
Turned a drag into cash and equity.
Precisely. And it sharpens their focus squarely onto the high-margin ad tech side of the business. It's a clear bet on scalability and profitability in that core area.
And are they putting that capital and their free cash flow to work?
They are. Management said they redeployed about $800 million of that quarterly free cash flow. Some went to the share repurchases we mentioned.
Okay.
And a significant chunk went into R&D, specifically for their AXON platform.
AXON, their AI engine. We'll come back to that.
That investment is clearly paying off. It's a big reason their software gross margins have climbed into the low 80s.
Low 80s gross margin for software. Just remind us, why is that specific metric, gross margin, so important, especially in ad tech? What does that tell you?
It's a fantastic indicator.
Yeah.
A high gross margin like that means for every dollar of software revenue, a very large chunk is left over after covering the direct costs of delivering that service.
So very efficient.
Extremely. It points to strong pricing power, very efficient technology, probably highly automated, and a really scalable model. For ad tech, it means their platform can handle volume without massive incremental cost per transaction.
And it sounds like that efficiency drive goes beyond just the tech.
It does. Operating expenses actually fell 8% sequentially.
Fell. Even while revenue was growing.
Even as revenue scaled up, yeah. It's just really impressive cost discipline, likely building on some earlier restructuring or layoffs they might have done.
So laser-focused, highly profitable, disciplined spending. What does that do for their overall financial health, their flexibility?
It means they're sitting pretty. They've got a strong balance sheet now. Net debt is only 2.8 times their EBITDA. That's very low leverage.
Very manageable debt load.
Right. And that $1.2 billion in cash gives them a lot of strategic options. Think potential tuck-in acquisitions.
Tuck-ins. So smaller strategic buys.
Exactly. Smaller companies that fit neatly into their existing structure. Maybe something in AI or bolstering their CTV, their connected TV capabilities.
Okay. And did they address the point some people raised about maybe a slight slowdown in FCF conversion or the pace of buybacks?
They did. Management basically attributed it to timing issues with working capital. When cash comes in versus when bills go out. Normal business fluctuations, they said, not a sign of any underlying structural problem or weakness.
Got it. So the financials paint a picture of strength and focus. But the future really hinges on the tech and the strategy management outlined.
Absolutely. The innovation roadmap is key.
Let's talk about that AXON AI engine. CEO Adam Foroughi really hammered this point home. He said AXON was the key driver behind record advertiser ROI.
Right. And crucially, he also stressed that AXON has significantly broadened their advertiser base beyond just gaming.
So what does that mean practically? Who are they reaching now?
It means they're not just a platform for game developers anymore. Because AXON, their real-time bidding AI, is getting so good at finding the right users efficiently, it's attracting advertisers from all sorts of other categories.
Like e-commerce, other apps.
Yeah, exactly. E-commerce, streaming apps, finance apps, travel. Basically, any business that needs to acquire customers effectively on mobile devices, it massively expands their potential market.
Opens up huge new revenue pools.
Definitely. And they also specifically called out Wurl. That's their connected TV or CTV ad tech platform.
Right, Wurl.
They labeled it a multi-year growth vector. That's a strong signal of commitment to the CTV ad market.
And CTV advertising it's a really hot space right now, isn't it? Why is it such a big opportunity for a company like AppLovin?
It's exploding. You've got viewers shifting away from traditional TV, cutting the cord. But advertisers still want that big screen reach. CTV offers that reach, but with the digital targeting and measurement capabilities online ads have.
Kind of the best of both worlds.
Precisely. And a company like AppLovin, with its existing data and AI power, is really well positioned to capitalize on that shift. Their core AXON 3.0 AI, that's what fueled the 77% revenue growth and nearly doubled ad EBITDA.
And they're not standing still with AXON 3.0.
No, they teased meaningful model upgrades coming in Q4. The goal is to grab even more ad budget from non-gaming advertisers and speed up how they make money from CTV. So expect even better targeting soon.
Okay, but maybe the biggest potential shift they discussed was this new self-serve ad platform, the AXON Ads Manager.
Yeah, that was a big reveal. It launched quietly, kind of under the radar, and they're planning a broader referral-based opening on October 1st.
Just in time for the holiday ad spend push.
Perfect timing. And the pitch sounds really compelling for advertisers.
What are the key benefits they highlighted?
Things like direct control over campaigns, easier credit card billing, tools for automating workflows, even auto-generating ad creatives.
Making it easier for smaller players to get started.
Exactly. And deeper integrations, too, like with attribution platforms. And they mentioned a new Shopify app they launched.
Okay, so this self-serve portal, how does that fundamentally change AppLovin's business? What's the strategic play?
It's potentially transformational because it opens the door to the huge long-tail market of small and medium-sized businesses, the SMEs.
Right, businesses that don't have massive ad budgets or dedicated teams.
Exactly. Instead of needing a big sales force for every account, they can onboard thousands, maybe millions of these smaller advertisers directly onto the platform. The CEO's vision is pretty bold.
What does he say?
He wants to enable any business of any size anywhere in the world to acquire customers profitably using their platform.
That puts them squarely in competition with the giants like The Trade Desk, maybe even Unity on the gaming side.
Directly. But they believe they have an edge with their deterministic data set.
Okay, deterministic data. What does that mean in simple terms? How is it different?
It means they base their targeting on direct, known user data from their huge network of apps, like this specific user did this specific action. It's not based on guessing or probabilities, which is what probabilistic data relies on. The idea is that deterministic data allows for much more precise and accurate targeting and measurement.
Giving them an accuracy advantage.
That's the claim. And another huge piece, their web ad campaigns used to be US only.
Okay.
But this new platform plans to open up to most major international markets on October 1st as well. They have a massive non-gaming user base outside the US to leverage.
Wow, so global reach for SMEs, that's a massive potential expansion.
Huge. And eventually, this whole platform will get its own brand, just AXON.
Makes sense. Separate identity.
And once it's fully open, they plan to actually start paying for marketing to bring advertisers onto AXON Ads Manager, shifting from just word of mouth to a more predictable, scalable growth engine.
That's a big step, using performance marketing to drive platform adoption.
It really is. It signals confidence they can acquire advertisers efficiently and profitably, fueling that compounding growth.
All right, so what does this all mean for the next quarter? What's the guidance?
For Q3 2025, they're guiding for revenue between $1.32 billion and $1.34 billion.
Okay, so that implies what, about 6-7% growth sequentially from Q2?
That's right. Solid sequential growth. And adjusted EBITDA is projected between $1.07 billion and $1.09 billion.
Which keeps that margin right around that impressive 81% level.
Exactly. They expect to maintain that high profitability. And part of that slight acceleration in sequential growth comes from, the impact of selling the apps business, plus ongoing improvements from the AXON AI models.
Okay, let's circle back to the investor context. We talked about that initial dip after earnings. You suggested it was likely positioning driven. Can you unpack that a bit more?
Sure. Positioning driven just means the selling might not have been about fundamental worries with the company itself. When a stock has had a massive run-up like AppLovin's has.
And it's had a huge run.
An absolutely huge run. So some investors might just decide to lock in profits on the good news, or maybe rebalance their portfolio if AppLovin's became too large a position. It's about portfolio management, not necessarily a negative view on the company's future.
So less about, something's wrong, and more about, okay, time to take some chips off the table.
Exactly. And while some commentary did point to that slight FCF deceleration or the buyback pace, management gave pretty clear explanations, as we covered. The overall vibe from the company and most analysts remains very bullish. It's still a beat and raise story with strong confidence in their AI advantage, their moat.
And that confidence isn't totally unfounded when you look at how they've performed versus the sector.
Not at all. AppLovin's has absolutely crushed the broader ad tech sector. Over the last year, the stock is up something like, 482%?
Incredible. Compared to the IGV Tech ETF, which is up maybe 25%.
Yeah, a massive outperformance.
Yeah.
And it's not happening in a vacuum. There are strong industry tailwinds helping them.
Like what?
Well, overall, mobile ad spending is picking up speed again. The headaches from Apple's IDFA changes, the privacy stuff, seem to be easing as the industry adapts.
So mobile ads are bouncing back.
Right. Plus, you have CTV ad budgets growing rapidly, like high 20% year-over-year growth.
Yeah.
And that shift tends to favor platforms like AppLovin's that can operate across multiple channels, mobile, web, CTV.
So fundamentally, the story here is AppLovin's transforming itself.
Definitely. From mainly a gaming publisher and ad network into this AI-powered multi-channel advertising platform.
What should investors be watching for in the near term then? What are the key catalysts or checkpoints?
Okay, near term, big focus on that September self-serve launch for AXON Ads Manager. How quickly do SMEs sign up? What does that early adoption look like? That's key.
Early traction metric.
Right. Then the Q3 results in early November, will they hit that 81% margin guidance again? And any news coming out of Wurl's fall upfronts regarding advertiser commitments for CTV.
And outside the company, macro factors.
Yeah, you always have the broader economy, but specifically seasonal holiday ad spending trends will be important. And sometimes there's chatter about potential S&P 500 inclusion for fast-growing companies like this, which can add some volatility.
Okay, and the longer view. What's the vision management is selling?
Long term, they believe If they execute well on this strategic shift, they can sustain mid-teens % revenue growth and keep EBITDA margins in the high 70s for several years. That's a recipe for significant value creation.
And they seem pretty confident about their tech edge, even with competitors talking about their own data sources.
Yeah, they kind of dismissed concerns about competitors using game engine data. They emphasize their own models, AXON 2, leverage vast behavioral data from their huge network, including billions of non-gaming users.
So the breadth of data is the key.
They argue their real advantage comes from expanding into new categories, getting even more diverse data from non-gaming users. That, they say, will make their AI models way more predictive over time.
More accurate targeting.
Exactly. And they also hinted that expanding their supply network to places where they show ads, their max network beyond just games.
Into other types of apps. Social, news.
Right. Social networks, music apps, news apps, websites. They suggested that's not some far-off dream, but a near-term plan driven by advertiser demand. It's all about building that comprehensive data ecosystem.
Creates a powerful flywheel effect.
That's the goal. More data, better AI, better results for advertisers, attracts more advertisers, generates more data, and so on.
All right, before we wrap up, it's time for our not financial advice segment. And we have to say it every time. This is purely for entertainment and education.
Absolutely. Not financial advice. All investing involves risk. Please do your own research.
Okay, disclaimer delivered. But we like to toss out a wild but maybe plausible idea based on the trends we're seeing.
And this one definitely fits the bill. It revolves around that strategic shift towards SMEs and non-gaming advertisers.
The idea, consider hypothetically a highly targeted, aggressive pair trade.
Specifically,
Right.
potentially shorting a portion of Meta Platforms, ticker Meta, while simultaneously going long AppLovin's, ticker APP.
Okay, shorting Meta, the giant, while buying AppLovin. That sounds bold. What's the rationale?
Well, remember, AppLovin's management explicitly said their current e-commerce advertiser base is tiny, less than 1% of Meta's reported numbers.
A huge gap.
Right. And AppLovin's new self-serve platform, AXON Ads Manager, launching globally over the next year or so, is aimed directly at that long tail of small and medium businesses that Meta relies heavily on.
So AppLovin is making a direct play for Meta's core SME territory.
That's the thesis. And AppLovin's pitch is different. It's built around extreme efficiency, that AI driving rapid conversions. They talked about conversions happening within 1-2 hours sometimes.
Very fast feedback loop for advertisers.
And they aim to automate the whole ad funnel, from finding the customer to the final sale. It's a more focused, perhaps more ruthlessly efficient approach compared to Meta's broader suite of tools for engagement, branding, and direct response.
Plus, AppLovin's CEO sounded very confident about their own model's profitability and their plan to use performance marketing to acquire those SMEs.
Suggesting they believe they can acquire those customers very efficiently, maybe more efficiently than incumbents over time. So while Meta is obviously a powerhouse,
Undeniable.
AppLovin could plausibly start aggressively chipping away at a really important and growing slice of that global SME ad spending pie. It makes it a potentially fascinating asymmetric bet, betting on a focused, AI-driven disruptor against the established giant.
Interesting food for thought. Definitely falling into that wild but plausible category.
For sure.
Okay, so let's bring it all together. Key takeaways from AppLovin's Q2. This is clearly a company deep in a major strategic shift.
Yeah, moving decisively beyond just gaming into broader AI-powered ad tech.
Yeah.
And doing it while delivering really strong financial results.
Strong performance now while laying the tracks for potentially huge future growth driven by that AXON AI, the new self-serve tools, and multi-channel expansion.
Those upcoming launches, the self-serve platform going global, those are the big catalysts to watch. They could genuinely redefine AppLovin's position in the market.
Which leads to our final provocative thought. As AppLovin sets out to help any business of any size anywhere in the world grow profitably, what other seemingly niche or overlooked market today might be ripe for disruption by a focused, AI-powered player?
It's a great question. Where could that kind of efficient, data-driven flywheel take hold next, and how fast could it happen? Something to ponder.
We definitely encourage you to do your own research, consider how these insights fit into your own view of the market.
Let us know what you think.
Share your thoughts with us, and we'll be back soon with another TalkTickers Deep Dive.